Phil, it's 60-40 or it's 60-35, a little bit of cash, whatever. What's working right now?
Hey, Tom. Good morning. Good to be here with you. There is a ton of noise. This has been an exhausting and emotional roller coaster, Tom. I mean, just to think about how we moved from, 40 million in initial jobless claims over the past few months, and 25% of all trading days this year, the market has moved by at least 3%. That is staggering. That's noise, though. I think the signals are a couple of the fundamentals that we're looking at. Fundamentals around the global reopening. China's May PMI, for example, over 50. The German IFO in Europe was up versus April, showing a tentative bottoming. U.S. PMI was up in May versus April. And mortgage applications, right? If you think about how important consumer sentiment in the housing market is, mortgage applications have gone up for 6 consecutive weeks. But, Tom, the big thing is that technicals continue to dominate. You're seeing, things don't move by 35% because everyone's fully invested. Folks are sitting on $5 trillion of money market funds. $5 trillion. That was just $3 trillion the same time last year. And the real signal we're taking has to come from the Fed, Tom. The Fed has cut the tail.
Well, this is amazing. And, John, what's so important here is I'm part of that $5 trillion of cash. It's a good feeling, John.
Except your cash is staying there, Tom, and it's not going anywhere anytime soon, I'm sure. Phil, let's talk about that $5 trillion of cash in money market funds. How much of that is just companies that have borrowed an absolute fortune and have had to park the cash before they draw it down?
Yeah, you know what, Tom? I'm sorry, John. You know what? I think it's more retail, actually, to tell you the truth. If you look at when that started to really rise, it was at the same time that we were seeing retail really run for the hills. Because if you think about what institutions do, institutions are far less emotional. I think a lot of that is retail, and I think that's what makes this pain trade so staggering, is the fact that, lower stocks are not the pain trade here. It's higher stocks. If you thought that last cycle's equity market was the most hated rally, what we've seen over the last 45 trading days is unbelievably hated here. People do not want to see this. And I think what the Fed really did on March 23rd, if March 23rd ends up being the bottom, people will remember March 23rd like they'll remember March 9th of 2009, right? The bottom of the market. But what the Fed did there, when they said they are going to come in and buy corporate bonds on both the secondary and the primary markets, that will go down as one of the most effective and creative monetary policy instruments in history. And I don't think that's hyperbole. What investors missed in this rally is that because this is a pandemic and a humanitarian crisis, that gave policymakers air cover to really deliver shock and awe. I mean, look what the European Commission announced last week, that they can borrow on behalf of the European Union. They're having an Alexander Hamilton-type moment in Europe right now. And this is all part of what is a staggering monetary policy response and fiscal policy response that for us means you can't be underweight equities here.